With the start of a new year, investors everywhere are asking the same question: which stocks actually have real upside left, and which stories are just hype? After a powerful run in markets, picking the right names now matters more than ever. Today, we'll be breaking down a diversified set of stocks and assets that reflect where the smart money may be positioning next across technology, consumer brands, commodities, and industrial recovery plays. One of the most dominant themes shaping markets right now remains artificial intelligence. Despite growing chatter about overbuilding and fears of an AI bubble, the reality on the ground tells a very different story. Companies like Nvidia and Broadcom continue to sit at the center of this transformation. Valuations may appear elevated at first glance, but when viewed through the lens of forward earnings and long-term productivity gains, these stocks still look far from exhausted. Corporate adoption of AI is still in its earliest stages. Only a small fraction of companies have meaningfully integrated AI into daily operations, and many are still in the planning and consulting phase. As implementation accelerates, demand for chips, networking equipment, and infrastructure continues to rise, supporting sustained earnings growth across the AI supply chain. Beyond technology, some of the most interesting opportunities lie in turnaround stories. Companies that were once market darlings lost their way and are now rebuilding. Starbucks fits squarely into this category, despite its iconic brand and global reach. The company struggled in recent years with operational inefficiencies and a diluted customer experience. That narrative is now starting to shift. New leadership has brought a renewed focus on execution, store experience, staffing, and efficiency. While turnarounds take time, recent improvements in same-store sales suggest the strategy is beginning to work. At current levels, the stock presents a compelling risk-reward setup for investors willing to look beyond short-term noise. Another asset class gaining renewed attention is precious metals, particularly gold. Traditionally seen as a hedge against inflation and geopolitical risk, gold is now benefiting from a deeper structural shift over the past few years. Central banks around the world have increased gold purchases at a steady pace. This move accelerated after foreign reserves were frozen during geopolitical conflicts, prompting many countries to reduce reliance on external currencies. For nations with relatively low gold reserves, increasing allocations is a logical step, and this trend shows little sign of slowing. Even after a strong run, gold continues to act as a strategic store of value in an increasingly fragmented global system. Industrial metals such as silver, copper, aluminum, and nickel are also entering what many believe could be a prolonged supercycle. These materials are essential for data centers, electric infrastructure, and next-generation technologies. As AI-related construction accelerates and global electrification expands, demand for these commodities may remain elevated for years rather than quarters. Unlike traditional boom and bust cycles, this demand is being driven by structural transformation rather than short-term speculation. In the media and entertainment space, Netflix remains a controversial but intriguing name. While subscriber growth has moderated and competition remains fierce, Netflix continues to dominate in original content production and global reach. Short-term concerns, round churn, and mergers have pressured the stock, but the company still possesses multiple levers for monetization. Its content library drives the majority of viewing hours, and strategic deals could further strengthen its long-term position. At current valuations, the downside appears limited relative to the potential upside if execution stabilizes. Boeing represents another high-risk, high-reward opportunity. The company spent years dealing with production issues, safety concerns, and delayed certifications, leaving the stock largely range-bound. Recently, however, signs of real progress have emerged. Aircraft deliveries are ramping up, quality controls have improved, and management expects a return to positive free cash flow, a milestone Boeing hasn't reached in a long time. While challenges remain, the shift from survival mode to recovery could mark the beginning of a new chapter for the aerospace giant. What ties all of these opportunities together is not a single sector bet, but a broader theme of Transformation. Whether it's AI reshaping productivity, legacy brands reinventing themselves, commodities powering the next infrastructure wave, or industrial giants fighting their way back, these stories reflect long-term structural change rather than short-term market noise. As always, successful investing is about understanding risk, managing expectations, and staying disciplined. The coming year will likely reward those who focus on fundamentals, earnings power, and sustainable demand instead of chasing headlines. If you want deeper breakdowns on these trends, valuation insights, and what smart investors are watching next, make sure to check out our full analysis and subscribe for more data-driven finance content. The market is evolving fast, and those who stay informed will always have the edge.